Right now, somewhere in the global silver market, a switch is being flipped. Not tomorrow, not next week, within hours. And when it happens, the price you see on the screen will no longer reflect the silver that actually exists. By the time most people realize what's going on, the move will already be over, and the only question left will be why they didn't see it coming. Silver has a habit of staying quiet right before it explodes. That's not hype, that's history. It compresses, it frustrates investors, it makes people lose interest. And then, without warning, it gaps higher so fast that charts look broken. We're sitting in one of those moments right now, the kind that doesn't announce itself with headlines, the kind that only becomes obvious after the fact. Here's what makes this different. This isn't a slow burn macro story where prices grind higher over months. This is a pressure cooker setup. Tight inventories, stressed exchanges, aggressive paper positioning, and a physical market that's quietly refusing to play along. Think about that for a second. A market where the paper price says one thing, but the real-world availability says something very different. How long can that last? Look at how silver trades compared to other assets. Stocks give you warnings. Crypto gives you chaos. Silver gives you silence. And silence is exactly what we're getting now. Volume dries up, volatility compresses. Commentators stop talking about it. That's usually the moment professionals start paying very close attention, because when silver moves, it doesn't ask for permission. What's happening under the surface is far more important than the price you see on your screen. Large players aren't buying silver because they think it's shiny or nostalgic. They're buying it because it's one of the few assets that exposes stress in the system immediately. You can't print it. You can't fake it for long. And you definitely can't deliver it instantly when inventories are thin. Ask yourself a simple question. If everyone holding paper silver asked for the real thing at the same time, what would happen? The answer isn't theoretical anymore. We've already seen delivery delays. We've already seen premiums disconnect from spot prices. We've already seen exchanges quietly adjust rules when things get uncomfortable. Those are not signs of a healthy, well-supplied market. And here's the part most people miss. Price doesn't move when the news breaks. Price moves when positioning breaks. When one side of the trade realizes they're trapped. When bids vanish and sellers hesitate. That's when silver jumps. Not in neat little steps, but in violent repricings that happen so fast they feel unreal. This is why timing matters so much right now. You don't get a polite countdown with silver. You get a sudden realization that the last price was an illusion. One moment it's calm. The next, it's gone. And the reason this potential surge could hit within hours is because all the ingredients are already in place, just waiting for one small trigger to set them off. Because in markets like this, the trigger is rarely obvious. It's not always a headline. It's not always a central bank speech. Sometimes it's a failed delivery. Sometimes it's a sudden withdrawal of liquidity. Sometimes it's one large buyer deciding they don't want paper exposure anymore. And when that happens, the reaction isn't gradual. It's immediate. Right now, silver is sitting at a point where even a small imbalance can cause an outsized move. Think of it like a tightly stretched rubber band. For weeks, even months, pressure builds. Nothing seems to happen. People get bored, they move on, but the energy doesn't disappear, it accumulates, and when it finally releases, it snaps back with speed that surprises everyone watching. What makes this moment especially dangerous for anyone on the wrong side of the trade is leverage. Silver is one of the most leveraged markets on the planet. For every ounce of real physical metal, there are many more ounces traded on paper. That system works beautifully when confidence is high. It collapses quickly when confidence cracks. All it takes is doubt. One question that can't be answered. One promise that can't be fulfilled on time. Pay attention to how quiet the mainstream narrative is right now. No panic, no excitement, no urgency. That's exactly when risk is highest. Markets don't break when everyone is screaming. They break when everyone is comfortable. When assumptions go unchallenged, when models say everything is fine. Silver has a long history of humiliating those models. There's also a psychological aspect most traders underestimate. Silver is cheap enough that it attracts retail interest, but important enough that institutions can't ignore it. That combination creates sharp, emotional moves. When price starts running, fear replaces logic almost instantly. Short sellers rush to cover. Momentum traders pile in. Long-term holders stop selling. Liquidity vanishes in minutes. And here's the key detail. This isn't happening in isolation. Bond markets are tense. Currencies are unstable. Trust in financial plumbing is thinner than it looks. In those environments, silver doesn't need a big reason to move. It just needs an excuse. Something small that exposes how fragile the balance really is. You might be wondering why hours matter instead of days or weeks. It's because once price escapes a certain range, algorithms take over. Stops get triggered. Margin calls hit. What looked like a calm market suddenly behaves like it's on fire. And by the time news outlets explain what happened, the opportunity window is already closed. This is why experienced market participants watch behavior, not headlines. They watch delivery data. They watch spreads. They watch what's happening when no one thinks anything is happening. And right now, all of those signals are flashing the same message. Something is close. Very close. Silver doesn't whisper forever. When it speaks, it does it loudly. And the people who benefit aren't the ones reacting. They're the ones who understood the setup before the move, before the shock, before the scramble, before the price everyone else is forced to accept becomes the new reality, and that's when the narrative flips instantly. One moment silver is ignored, dismissed as dead money, a boring metal that never does anything. The next moment it's being talked about everywhere, framed as obvious, inevitable, and no longer cheap. That emotional whiplash is not an accident. It's how this market transfers wealth from the impatient to the prepared. At that stage, logic comes second. Price becomes the message. People don't ask why silver is moving anymore. They ask how high it can go. That's when late buyers rush in, not because the fundamentals suddenly changed, but because the screen forced them to pay attention. By then, the easy part of the move is already gone. What's critical to understand is that silver doesn't surge because everyone agrees. It surges because disagreement becomes impossible to maintain. When physical holders refuse to sell. When shorts realize rolling positions is getting expensive. When buyers accept higher prices without hesitation. That's when the market reprices in real time. This is also why the biggest moves often happen outside normal expectations. Overnight sessions. Thin trading hours. Moments when liquidity is weakest. A single aggressive bid can force a cascade. And once that cascade starts, there is no pause button. You don't get a second chance to react calmly. The market moves first. Emotions follow. People will later point to a reason, they always do. A data release, a geopolitical headline, a comment from an official. But those are explanations, not causes. The cause is always the same. Too much leverage, too little metal, and too many people assuming tomorrow will look like yesterday. Silver punishes complacency. It always has. It waits until confidence peaks, then reminds everyone that scarcity is not a theory. It's a physical reality. And when that reality asserts itself, price has no choice but to adjust violently. This is why moments like this matter. Not because of predictions, not because of price targets, but because of structure. Because when a market is stretched this tightly, the direction of release matters less than the speed. Up moves happen fast, down moves grind. That asymmetry is what makes silver so dangerous and so powerful at the same time. If you're watching silver right now and thinking, nothing is happening, that's exactly the mindset these setups create. Silence, distraction, doubt. And then, suddenly, movement, real movement. The kind that doesn't wait for consensus or comfort. By the time most people feel confident enough to act, they'll be acting under pressure. Higher prices, faster volatility, less clarity. That's how it always works. The window doesn't close. Slowly. It slams shut. The real question isn't whether silver can surge. History already answered that. The question is whether you recognize what these quiet moments mean before they're gone. Because once silver decides to move, it doesn't send reminders. It sends a bill. In the end, silver doesn't reward excitement. It rewards awareness. It rewards understanding how fragile the system really is when too many promises chase too little metal. And right now, all the signs point to a market that's about to remind everyone of that fact, fast.